Charlie Javice, the founder of Frank, has just been convicted of one of the most high-profile startup frauds in recent memory. A young founder who once claimed to be revolutionizing the student financial aid system is now a cautionary tale. But here's the thing. Startup fraud doesn't usually look like a criminal mastermind in a hoodie. It often starts with a founder under pressure. Pressure to hit impossible numbers, to impress investors, to live up to the story they've already sold. Sometimes that pressure causes them to cross a line. In Javis's case, she hurdled that line at full speed, creating a $175 million scheme that fooled investors in one of the biggest banks in the world. So how does something like this actually happen? And why does it happen more often than people realize? Let me set this up real fast. So Charlie Javice was the founder of the student financial aid startup Frank and was sentenced on September 29th to 85 months, which is just over 7 years if you're trying to do the quick math. And she was sentenced to federal prison after being found guilty on 4 counts, including securities fraud, wire fraud, bank fraud, and conspiracy. She also was found civilly liable in order to pay restitution of $287.5 million. Her co-founder, and I don't know that I'm pronouncing this name correctly, Olivier Amar, was Frank's chief growth officer and was also convicted. The trial was only 6 weeks long, and at first glance, that seemed fast to me, but come to find out, that's actually pretty average. Javice did plead not guilty at the beginning of the trial, but 6 weeks later, a jury found her guilty and her chief growth officer as well. So what was Frank? It was a platform that streamlined student aid and loans for college applicants. It did things like make the FAFSA application easier and faster. If you've ever had the pleasure of applying for FAFSA, which everybody does, either the student or the student's parents or some combination, it's a pain in the ass. It's tons and tons of repetitive questions. You have to dig around for your own financial records. You have to look for things that you haven't thought about in years. And for a lot of people, it's pain and suffering that ultimately doesn't result in a ton of support if you make over a certain amount of money or your household combined income is over a certain amount of money. So Frank was trying to help, or Frank the platform, so weird, it's almost like talking about a human being. Frank the platform was supposed to be helping students navigate kind of that complicated process more quickly and easily. It would do things like populate forms and populate certain inputs that were either repeated or needed to be filled out multiple times. And so it just tried to streamline all of that. So what actually happened with all of this? So Frank was building as a startup. I think they kind of build themselves as a fintech startup. And JPMorgan, yes, that JPMorgan, the biggest investment bank in the world, or arguably one of the biggest investment banks in the world, was looking for fintechs to buy. They were on a bit of a buying spree. For a lot of these banks, it's easier to acquire than it is to build, so buy versus build. And they were very much in that mode, trying to find dozens of these opportunities. And Frank ended up being one of them. So they went into a due diligence process, kind of a standard series of practices around looking at an investment in this case. And they bought it for $175 million. Now, that $175 million was based off of a valuation that was tied to the user base. It was almost entirely tied to the user base. See, Frank, in essence, was valuable because of how many users it claimed it had on its platform. And at the time of JPMorgan's purchase, Frank claimed, and more specifically Javice, claimed to have 4 million users on the platform. Problem is, Frank only had like 300,000 users. I hope you're enjoying the content, and if you are, please consider subscribing to the channel. Back to the episode. When the due diligence was happening with JPMorgan, they started asking, hey, we need to know a little bit more about these users. We'd like to have some records. we'd certainly like to have an understanding of the unique characteristics of each one of these users. In essence, they were trying to verify that these users exist. Now, I have no idea what happened next. I would assume Javice freaked out and Amar freaked out that now they had to produce the actual information around these users they claimed numbered 4 million or close to 4 million when only having about 300,000. I do know that based on the trial and what came out during the questioning or during the trial procedures, that Javice had hired a computer science professor, and they started to run a fairly elaborate scheme that generated fake users and did things that were kind of sophisticated. So they made sure that the email addresses looked like real email addresses, that they didn't replicate any names, that there were actually some demographics and backstory and quote unquote pedigree that looked real. So in other words, like this looked like a user that would actually be on the Frank platform, actually using the software. And it worked apparently fairly well because they got through that due diligence. And I'm gonna circle back to that in a second about how that happened and what happened afterwards. The platform itself supposedly worked. Now, I will say the FTC had gotten some complaints from users, from the general public, that it was kind of overbilling what it did, or it was overselling what it did, because a lot of the stuff was just basically forms and repetition and boilerplate, and they kind of made it sound like it was this customized, truly unique set of solutions on a kind of student by student basis. But the core of the fraud, make no mistake, were the fraudulent users. So fast forward, this transaction happens. JPMorgan buys the company. The question is how did JPMorgan find out? Well, surprisingly, it was 15 months after the acquisition before JPMorgan got kind of the first real clue that these users weren't real. They tried to mass email the entire Frank user base, and the failure rate was, and I'm using terminology from the trial, quote, exceptionally high. I would assume high by 3.7 million or so, since they claimed 4 million and they only had 300,000. So JPMorgan then launched an internal investigation. They did a deep dive. They started getting kind of on the forensic level of all of this, and then that's when they found all of those fraudulent accounts. And almost immediately, JPMorgan filed suit against Javice and I guess effectively Olivier as well in 2022. But again, it was 15 months after they had completed this purchase before they even found the fraudulent accounts. What's interesting to me about this whole story, and I think some of the biggest kind of discussion points around this hover around JPMorgan's miss in their due diligence, and how did such a sophisticated, such a large, such a well-resourced, such a talented investment bank like JPMorgan miss this in due diligence? And I think there are a couple of factors. I think they were moving very fast. I mentioned a few minutes ago they were on a buying spree. They were trying to find a lot of these fintechs to invest in a very short period of time, and they were trying to get these deals done. Early stage deals like this, they do move pretty quickly, because this is going to sound kind of bad or maybe surprise some people, but $175 million for a bank with the assets of a JPMorgan is kind of a rounding error. It's actually not that big a deal. And I'm going to come back to that in a minute about why it surprised me that JPMorgan was so public about this lawsuit in just a second. But the fake accounts were sophisticated. They were sophisticated enough to pass kind of basic scrutiny. So if you randomly selected and looked at individual records throughout the stack of all of these user accounts, they looked legit. They looked like real people. And one of the things that happens in due diligence that I don't think a lot of people know, if you've not actually run due diligence as part of kind of the underwriting of a private equity transaction, is you don't really want to mess with customers. You don't really want to call them and ask them about a company you're interested in investing in or purchasing or whatever the case may be because it spooks them. It's a weird call. Like, how do you have that phone call? Hi, this is Matt calling from JPMorgan. We're thinking about buying Frank. What's your experience been as a user? That just doesn't really happen, and doesn't happen for all the reasons I kind of just laid out. And it also doesn't happen because it's a pain in the ass, and bankers don't want to do that kind of work, just being honest. Now, I have no idea what that due diligence team looked like at JPMorgan. I have no idea how it operated, and I certainly have no idea. There could have been the one lone voice sitting in the corner, recent grad from Fordham, who's putting his hand up or her hand up and saying, something doesn't smell right about this, and the grizzled veteran investment bankers are all just shushing the young pup in the corner. That very well could have happened, but in any case, they ignored it or they missed it or something, because they basically trusted the data they were given. And as I said in the opening, this kind of due diligence failure happens more often than you think. I mean, the frequency would probably surprise most people when you just miss something in due diligence. Now, to me, this is a sliding scale. Usually, if you miss something in due diligence, it's kind of small. It's relevant, but maybe it's not meaningful. It's somebody made an honest mistake. Somebody transposed a number. Somebody inserted something into a column it didn't belong in a spreadsheet in a data room. It's not something they did intentionally. It's certainly not something they tried to conceal. It was a mistake. And sometimes you'll miss those things. Sometimes you catch them, you fix them, all of those things. But it happens a lot. There is a level of trust that's required in any of these private equity transactions, probably to a degree that most people couldn't appreciate, because especially in early stage companies, there just isn't a lot of data. There's not a lot of history. There aren't a lot of things that you can check for validity. You're trusting this founder and this founding team to be honest with you, to tell you what the real story is, to provide you data that's trustworthy, and you go with it. That's just kind of a cornerstone of how these deals get done. And before you say, well, I would just ask them for all this extra stuff, and I would call all their customers, and I would check every single data point and all of that stuff. That's nice, and I hear you, but you wouldn't actually do that. And the reason you wouldn't actually do that is for a practical reason, which is if you develop a reputation of being a pain in the ass as an investor, you're not going to get the opportunity to participate in a lot of the deals you want to participate in, because you're going to be seen as a pain in the ass. And if all dollars are equal or all terms are equal in a deal, a founder is going to choose to do work with an investor whose reputation precedes them as being easy to deal with or nice to deal with or pleasant to deal with. They're not going to choose the pain in the ass, even if your name is JPMorgan, over somebody who's a lot easier to deal with. And we've had this happen to us. We had a couple of founders actually do what I would consider fraudulent activity, and we had one that just absolutely defrauded all of their investors. And it was a really elaborate scheme. There were faked SSL websites. There were bank statements that were doctored. There were unbelievable amounts of craft put into the scheme to fool a bunch of people. Now, I can't get into too much of it because it's an open legal issue, and I'm just not going to put myself in that position. But I will say, I still felt dumb. It was an elaborate scheme, but I felt dumb, like I had been fooled. They had gotten over on us. About 3 weeks after all of this went down or kind of came out, I was talking with a VC that co-invested with us in a completely different deal that's going very well. That's certainly not fraudulent. Very excited about that one. And this VC has a lot more experience than I do. Has been very successful, can point to a dozen different successful investments over his career. And he was asking me about this, and I was telling him what was going on, and I was kind of had my proverbial head hung low. And without missing a beat, he says to me, "Oh yeah, we get one of those about every 3 years." And so figuratively, my jaw hit the floor, and I looked at him and said, "Really?" He said, "Oh, absolutely." He goes, "There's just some level of this that comes with this kind of investing, that comes with these kinds of founders at this kind of stage of company. And I was really surprised, but admittedly a little bit relieved as well. And I had another kind of adjacent experience with that level of fraud in a previous business life when the company I was working with wholesale bought a company. And they had relocated it and upgraded the equipment and upgraded the staff and all the processes and the technology and everything that needed to do to really actualize this investment. Come to find out that a very real percentage of their customers were getting kickbacks from the previous ownership. They would bring them business, in exchange would get, presumably cash in like, a kava bag. But regardless, they were not bringing it in kind of the full faith and good nature of just a business relationship. They were expecting cash. And so that really threw that organization for a loop, understandably. They now had to understand that the customer base they thought they were purchasing or thought they were going to get as a part of this acquisition just didn't exist, or certainly didn't exist in a way that they were willing to do business, and that set them back pretty significantly. And I also think it's important to understand it's not just the due diligence where investors kind of lose control or don't have the governance or oversight that I think a lot of people believe they do. Yeah, I get it. You can do equity deals, or you could do a large enough purchase as a percentage of the outstanding shares where maybe you can be on a board, or you can have a board seat, or you can have that kind of oversight and that governance. But there really aren't that many safeguards in place once that investment is actually wired to that startup, that business, that founder's bank account. How the money's spent, where it goes, how the budgets are managed, who gets paid what, that's actually not as protected as you might think it would be. There's very little that actually prevents a founder from taking that wire, 100% of the investment, and leaving the country and just ghosting you. I know that sounds crazy, and I've heard of some pretty elaborate schemes that investors have put in place to try and prevent that from happening. But when you really boil it down, there's almost nothing that you can do. So all of these transactions have some level of trust baked into it. And when I say these transactions, I'm talking about early stage stuff. Yes, if you're doing an LBO, if you're doing mezz debt, if you're doing some sort of structured debt vehicle for a multinational $10 billion a year company, this is not really going to happen. There's too much data. There's too many ways that a fraud could fall apart and would certainly make itself available. But there's always going to be a level of trust required in these early stage transactions because there isn't that much data, because you can't check every little thing. And you do want to get these things closed. And for the amount of money you're trying to move around, speed actually matters in a palpable way. So here are a few things I hope you would take away from this episode. All fraud isn't by founders only. I think it's important to say that out loud. Most of investor bad behavior stops short of fraud. Yeah, there can be some weird legal language. There can be some things that an investor does after the transaction that may seem untoward. It may even seem unethical. But it usually stops at being illegal, usually stops short of being fraud. But there is bad behavior there, and I think that's important to point out. But founder fraud is real, and it happens, and it probably happens more than you would expect. To a great extent, we have founders that frequently play fast and loose with the truth at minimum. They overstate things. They may actually lie through omission or just strategically leave things out that are either damning or difficult or make it harder for them to raise money. I think it's interesting that JPMorgan took this kind of calculated risk in pursuing this lawsuit publicly. $175 million for a firm the size of JPMorgan is kind of a rounding error. I know that sounds extreme and maybe even a little bit gross, but it's the truth. If you look at their balance sheet, they made like $81 billion in profit last year. So it was a little surprising to me that they wanted to kind of showcase if nothing else, a bit of a bungle on their side from this due diligence that they clearly didn't do or didn't do well enough, over $175 million. Now, they may not have had a choice, right? They may owe that in their corporate governance to their shareholders or to internal stakeholders, or that just might be their way of sending a signal to everybody else who would think about trying to defraud them. So maybe it was just calculated off of that, and they said, we're going to take a little bit of a reputational hit on our due diligence, but we'll clean it up internally. We're going to try to get this money back. Now, I will say I don't think that Javice or Olivier can actually cover their civil judgment. They just don't appear to have those kinds of assets. It's over $200 million, so not many people have access to those kinds of assets or certainly cash. And again, this happens in quiet more often than the general public understands. Just because it doesn't get splashed across the headlines of the Wall Street Journal doesn't mean it isn't happening. It happens a lot, and it happens in varying degrees. Does it happen to the degree that we saw with Frank and what Javice did? No, that's a bit of an outlier, thankfully. But we've certainly seen it with Theranos. We've seen it with other high-profile companies that certainly defrauded their investors. And the last thing I hope you take away from all this is that trust will continue to be a necessary component in all of these private transactions. You're just not going to be able to verify everything. You're not going to be able to get deals done if you're checking every last data point. That's just not how deals get done. And time will kill some of these deals if they don't happen fast enough, or they'll move on, or whatever the case may be. Just the inertia of a deal will suffer. So some of these things are going to continue to be taken on trust. So just to sum this all up, Charlie Javice's conviction shows us just how far a founder can go when pressure outweighs integrity. It wasn't necessarily about a mastermind scammer. It was more likely about someone who kept doubling down until the story collapsed. And there's shared responsibility here. Due diligence failures, some of them self-imposed, expose the vulnerabilities, both design and unintended, in private equity investing. For investors, founders, and anyone participating in this space, the lesson is clear. Fraud isn't a bug, it's a feature. While it doesn't always start with bad intention, it always ends poorly. That's it for this episode. Thanks so much for checking us out. As always, like, comment, and subscribe, and we'll see you next time.